Steve Peterson here with Infinity Investments, and welcome to our channel where we talk all things commercial and investment real estate. And in today's video, we are going to continue our series on 1031 exchanges, as this is a hot topic right now with the Biden administration, but talking about, and I hope it's just talk about potentially eliminating the 1031 exchange tax deferral option when you sell your investment properties. So we're going to be talking about today the replacement rules. When you're doing your exchange and you're looking for your replacement property, the thing that makes 1031 exchange extremely difficult, I would say, is the replacement rules. But once you have a clear understanding of these rules, the game becomes a lot simpler, okay? And the number one rule I'm going to start off with is when you exchange, you have to exchange, when you sell your down leg property, what's called the relinquished property. When you sell that property, you have to exchange at that value and up. So if you sell $1 million property, you have to buy $1 million worth of property and beyond. If you buy $900,000 worth of property, you're going to have what's called boot. Boot is all bad when it comes to exchanges. Essentially, boot is money you're going to have to pay some taxes on, capital gains taxes on. So when we're doing this exchange, ideally, you want to not pay or defer, that's the right word, defer all of your capital gains taxes. Now, as a side note, sometimes investors will say, hey, I need a little bit of cash to stick in my pocket. Let me take a little bit of cash out of this exchange. That is going to be boot. You're going to be taxed on that. All right. Make sure you talk to your accountant when you're doing stuff like that, because sometimes there's instances when you take out some boot, it could be a lot more damaging than you thought it was. But in general, we don't like boot because there's taxes paid on that. So what we're talking about is how to be completely tax deferred. So you've got to, whatever you sell out of, buy that or more. Pretty simple, right? But this gets missed, and it gets missed a lot. So you sell $1 million, you got to buy $1 million or more. You can't buy less. Anything less, you're going to be taxed on that amount. As if even if you spent all your cash in the deal and you bought less, you would have a taxable event. Now, that brings me to the second point, which is like a rule of thumb in the business called spend the cash, replace the debt. Now, it's not the scientific term, but on the streets of commercial real estate, investment real estate, you got to spend the cash and replace the debt if you're going to have a qualified exchange. So what does that mean? You sell $1 million worth of property. Let's just say there is $600,000 of cash coming to you at the sale, and there's $400,000 loan that you paid off. So when you go and you buy the next property, that's $1 million. You've got to spend the $600K, and you've got to replace the $400K of debt. That's very, very important. You got to replace that debt as well, because a lot of times people think, I'm going to exchange, so my $1 million property, I'm going to get $600,000, I'm going to go pay all cash for something $600 grand, be done with debt, I'm going to kick my feet up, live the free and clear life. That's fantastic. But if you were to do that, you would pay a significant amount of taxes. Because again, going back to principle number one, you've got to replace the entire amount of value that you sold out of. You got to exchange it up. That's what you've got to do. The second thing you got to do is you got to spend all that cash, and you've got to replace all that debt. The government and the banks, they got a good relationship, right? So the way it works is you don't want to pay, you want to defer your capital gains tax. You got to continue that debt on to the next one. Now, you can go to a different lender. You can get seller financing, but you've got to replace that debt, okay? That is really, really important. Now, for you people who are potentially investing into DSTs or tenant in common, fractional interest investments, it gets a little tricky. This is where it gets a little tricky, because let's say you're investing into a fractionalized deal, a syndication of sorts. That's qualified, by the way. And when you do that, you have to make sure that you're not just getting an LLC interest. You have to get a deeded interest into the property. All right. But let's just say you're doing that. You got all that worked out. You've got an allocation of cash and debt that you're selling out of. When you go into that replacement or that upleg property, that property and your percentage of ownership, that has to be the ratio of debt to cash in that deal has got to match your ratio of debt to cash. And there's a lot of ways the company, so if you're doing a DST, just make sure you got a qualified sponsor that really knows what they're doing, and their legal team and everyone and your team, make sure you got the numbers right, because this allocation has to be done, and it has to be done right, because you got to spend the cash and replace the debt. And how you do that when you invest in a syndicated deal where you as the investor, you're not getting the loan. You're not applying for the loan. You're not, that's part of why you probably want to make an investment like that, right? The loan's on the sponsor. You just want to put in some money and get a rate of return. Well, that sponsor has to give you an allocation of debt. That allocation has got to be equal in regards to the ownership percentage that you're coming into. And that allocation of debt and equity has got to jive. It's got to make sense. It's got to be equal to what you sold out of. Make sure when you're doing that, particularly that you have some qualified people that you're working with, the sponsor that you're going to invest with, your QI, your qualified intermediary, the person, the company handling the exchange, and then your accountant, because the allocation's got to make sense. Why is that? Because you got to spend the cash and replace the debt. Okay, that's just, and if you're buying your own property, you got to keep that debt load going, guys, if you want to be totally tax deferred. And you could always buy something all cash. Just understand you're going to be paying taxes without cash that you have. And that's like the worst. If you exchange up and you buy something, you spend it and you invest all your cash free and clear, but you owe taxes, that's a tough one. So if you're wanting to go that route, just understand what you're dealing with, right? We're talking about being totally tax deferred. So spend the cash and replace the debt, all right? Next one we're going to talk about is really, really, really important, is how the basis is not affected when you refinance. And here's what I mean. Your capital gains is calculated based on your net sales proceeds and your adjusted basis. You own this property over the years. You bought it at a certain amount. Most of us on investment property, you're going to depreciate that on your taxes over a 27.5 or 39.5 year schedule. That's going to get taken away from your basis. If you made any major capital improvements, that's going to be added to your basis. What's not going to add to your basis is when you refinance. And this is a lot of times people get this really, really wrong, because they'll refinance, right? Let's say you got a $5 million property. When you bought it, your basis was, let's say, $2 million. And now it's worth $5 million. You're getting ready to sell it, it's $5 million. But along the way, you said, hey, I'm going to refi, take some cash out, right? Market went up, doubled in value, whatever. So now you refied for $3 million. So your basis is $2 million. You refied for $3 million. So you got $3 million, a $3 million loan that you need to replace. Again, you took $1 million tax-free. Good thing you could do when you refi. But your basis is still what it was when you bought it. That refi didn't step your basis up. It don't work like that. All right? That's important, because a lot of times people, when they refinance, they think their profit, because when you sell the property, the cash you're going to get is based on your, sales price minus your cost of sale and minus your loan. All right? But your basis is still the same whatever it is when you bought it, whatever your depreciation schedule is, plus what you put into the property, right? All things considered. I say all things considered because, like, if someone passes away and they, give the property or transfer the property to their beneficiaries, the beneficiaries can get what's called a step up in basis at that time. The basis can step up to wherever the value of the property was when that person passed away. We ain't talking about that. We talking about when you're still alive, you refinance your property, you took some cash out, feeling great. Now you go down the line and you're selling and you're going to do this exchange. Cool. Just understand the exchange numbers, the gain is still based on that actual basis. And your refinancing does not step your basis up. It puts some cash in the pocket tax-free. But you've got to then, again, spend the cash you got and replace the debt. I'm not saying don't refinance. Just understand what you got when you're doing that. It's very important, because that pops up, man, a lot with the clients who have refinanced. And a lot of clients, as of late, have obviously properties, quadrupled in value. People refinance, took advantage of that. So just understand the rules when you're doing this exchange. Last thing I want to talk to you about is the identification of properties. All right, the 3 property rule and the 200% rule. So the general rule of thumb, the easiest way to do it, the least complicated way to properly identify a replacement property or properties, it is the 3 property rule. So from the day you close, by the way, you got 45 days to identify. Calendar days, not business days. Holidays are not exempted or excluded. 45 days. Within that 45 days, you got to properly identify up to 3 properties. And you identify them by filling out the identification paperwork that the qualifier intermediary issues you. And they can be 3 properties. You can buy 1 out of the 3. You can buy all 3. But in order to qualify your exchange, remember, you gotta, whatever you sold out of, you gotta buy that value or more. You gotta spend that cash and you gotta replace that debt. All right? And it can be 1 property or it can be up to 3 properties. Now, there's another way where you can buy more than 3 properties. Now, this gets tricky, very tricky. It's called the 200% rule, where you can buy an unlimited amount of deeds. You can buy, say, 10 properties. However, if you were to do that, the aggregate value of all those properties cannot exceed 200% of what you sold out of. All right? Now, this gets complicated because of this 200% rule and all these different properties. I had to do this one time when my client was buying an apartment building that was made up, or I should say it like this, an apartment complex that was made up of many different buildings, meaning that there were, I think, 5 parcel numbers. So that was more than 3, right? But it was 1 building, one complex. But the complex had 5 separate APNs, 5 separate parcels. So that was 5 properties, exceeding the 3 property traditional rule. So they had to go in what's called the 200% rule. That ended up working out because all 5 of those properties did not exceed 200% of the original property that they had sold out of. Okay? Very, very important. Try to stick to the 3 property identification rule. It's a lot simpler. You don't have to do calculus in order to figure it out. But, if you have more than 3 properties, there's options for you, okay? I'm going to do a video on just the 200% rule, okay? And I think that'll be the next one as part of this series because there's a lot of misunderstanding. There's a lot of complexity to it. There's a lot of frustration to it, but it could be an option for you. That happened to me. We were buying that property. As we didn't realize it was separate APNs until like the 44th day. Luckily, the property values didn't exceed 200%. But now I know that going into it, I'm going to share that with you. I hope this information helps. There's a lot of moving parts in 1031 exchanges, and we need to keep this thing going. Whether you Republican, whether you Democrat, I understand that as a result of the stimulus, look, there's going to be some increase in taxes. We got to pay for all this money the government put out there, right? Let's not pay for it with the 1031 exchange, though. We need that. That's a vital part of the economy. It's a vital part of small business owners, small investors' portfolio, and the way that, someone starting out can advance their way up in the investment world. It's something we need to keep. So write your local congressperson, tell them how important the 1031 exchange is to the economy. Let's keep this thing rolling. Hope this is helpful. If it is, like, subscribe. Let's stay tapped in. Best of success to you in your investing career.